Taxes. The word brings fear into bank accounts all across America. You know, the IRS kind of reminds me of Debo from the movie Friday, right? No matter how you receive your income, where you receive your income, or why you receive your income, you could bet that the IRS wants their fair share of it. You know, most people know that income from, say, your job or an investment is taxable, but you'd be surprised at the number of things that are considered taxable that you never would have thought of. Hey, if you're new to the channel, I'm Karan from Life Accounting, the #1 firm for financial education. Now, be sure to give this video a like to help others see it on YouTube, and subscribe to the channel so you don't miss out on future videos. And if you have any questions or just want to say thank you for the video, be sure to leave a comment below. All right, enough of that. Let's get into it. Here are 10 outrageous things that the IRS wants you to pay taxes on. Yep, that's right, illegal activities. Even criminals are required to report their income to the IRS. So if you are involved in, say, embezzlement, a little theft, or any other illegal activity, all income derived is considered a part of your gross income. Now, the most well-known case of illegal activities and taxes is the case of Al Capone. You see, in the 1930s, Al Capone was the leader of a criminal organization in Chicago. He didn't land in jail for bootlegging alcohol during the Prohibition. He didn't even land in jail for murder. Heck, the FBI didn't have enough evidence. But in 1931, Capone was found guilty of 22 counts of federal income tax evasion and was convicted to 11 years in federal prison, in addition to $215,000 in interest and back due taxes. You see, despite his public displays of wealth, Capone never filed a federal tax return, which turned out to be a grave mistake. Next up. In 2020, a man at Diamond State Park in Arkansas thought he found a piece of glass. The dark stone, about the size of a marble, turned out to be a 9-carat diamond worth more than $1 million. It's the second largest diamond ever found at the state park. Now, you bet he was smiling the entire way home. But you know who else was smiling? The IRS. Because if you find and keep lost or abandoned property, the IRS would like you to pay taxes on it. The newfound property is taxable to you at its fair market value in the first year it's in your undisputed possession. The thought behind this so-called treasure trove tax dates back to 1964, when a couple found over $4,000 inside a used piano they bought for only $15. Yep, the IRS ruled that the couple owed income tax on the found cash, and the U.S. District Court agreed with them. Alimony. Before 2019, the payer of alimony was able to deduct the payments from their income, and the receiving spouse didn't need to include the payments in their income at all. Well, the Tax Cuts and Jobs Act was a divorce party pooper and removed the deduction from the tax code for all divorce agreements and decrees that start between 2019 and 2025. So within that time period, alimony cannot be used as a deduction for the person who pays it and must be reported as income for the person that receives it. Are you a crooked politician or someone who occasionally takes money in exchange for government contracts? If so, this one is for you. In 2011, 2 U.S. Army Corps of Engineers employees pulled off the largest bribery and bid rigging scheme in the history of federal contracting. That's according to the U.S. Attorney. They didn't get to enjoy their inflated income for too long before they were arrested and charged with taking kickbacks, get this, worth over $20 million in exchange for large government contracts and inflating invoices. Not only were the FBI looking for them, so was the IRS. And that's because on page 74 of publication 17 from the IRS, it clearly states, if you receive a bribe, include it in your income. Doesn't get more cut and dry than that. Let's talk about canceled debt. The ability to get a portion of your debt canceled by a creditor is considered a victory that the IRS would like to celebrate with you. In general, if you have debt that is canceled, forgiven, or discharged for less than the amount you were originally required to pay, the amount of the canceled debt is taxable. and you must report the canceled debt on your tax return for the year the cancellation occurs. For example, if you have a debt of $5,000 and the creditor states you just have to pay $3,000, you have $2,000 of cancellation debt that must be reported as income on your taxes. This applies to credit cards, to mortgages, and almost all other debt. But there are a few exceptions like student loans and debt discharge because of bankruptcy. Are you a standout employee? Did you get rewarded in the form of extra cash or trips? If so, you may have to pay taxes on the value of your reward. That's because gifts from an employer to an employee outside of context of employment are generally taxable to the recipient as supplemental wages. Over 4 decades ago, the Supreme Court ruled in the Commissioner versus Duberstein case that a transfer only constitutes a tax-free gift if it is made through a detached and disinterested generosity, or out of affection, respect, admiration, charity, or like impulses. And unfortunately, gifts for doing good at your job does not meet the requirement for a tax-free gift, but keep being an outstanding employee. Yep, in April 2020, the unemployment rate reached 14.7%, the highest rate observed since data collection began in 1948. Due to the national crisis, there has been an unprecedented surge in unemployment claims, with millions of people receiving unemployment benefits and some still receiving them to this day. But what some people don't know is that unemployment benefits are taxable at the federal level and may be taxable at the state level too. Be sure to check Form 1099-G sent by the IRS that will show you if any taxes were removed from your unemployment benefits. If not, you may owe taxes on those benefits. My favorite form of gambling is poker, but one thing I wouldn't gamble with is the IRS. No? I should stop? Okay. On a serious note, gambling income is considered taxable income at the federal level and may be taxable at your state level too. And no, gambling is not just at casinos. It includes but is not limited to lotteries, fantasy sports, racetracks, game shows, and sweepstakes. If your winnings are large enough, you will receive Form W-2G from the payer, but it is your responsibility to report that income even if you don't. All right. Let's talk about scholarships. In general, if scholarship funds are used for qualified expenses, such as tuition, fees, books, and course-related costs, such as supplies or software, the scholarship is tax-free. On the other hand, if a portion of the scholarship goes toward non-qualified expenses, such as room and board and travel, then that portion of the scholarship is taxable. I know it's a surprise, but businesses who barter for services or goods are expected to report the exchange on their tax returns. Yep, according to the IRS, if you barter, you must report on your tax return the fair market value of the products or services you received in the year you received them, and both parties must report as income the value of goods and services received in exchange. But don't get too nervous because there are some exceptions. The IRS provides some clarity by stating that the term doesn't include arrangements that provide solely for the informational exchange of similar services on a non-commercial basis. For example, a babysitting cooperative run by neighborhood parents. Well, there you have it, an outrageous list of things you are taxed on. I truly hope this helped someone today. If it did, go ahead and hit that like button for me so others can see this video on YouTube. And don't forget to subscribe to our channel so you don't miss future content. I'm Karan from Life Accounting. Until next time.